Why wealthy families never keep money in a bank, and where they put it instead. A bank is the worst place a wealthy person can store cash. It loses to inflation, it's only insured up to $250,000, and it generates fully taxable interest. Yet most six-figure earners still keep most of their savings in one. Today I'm showing you where the ultra-wealthy actually park their money, and not a single one of these places is a bank. There are 4 cash equivalents the wealthy use instead. One you've heard of and dismissed. One you've never heard of unless you have $10 million. One generates 5% yield backed by the federal government. And one is a literal tax-free hedge fund disguised as a life insurance policy. Stay with me because the last one is the closest thing to a money cheat code that legally exists. First, why not the bank? 3 reasons, in increasing order of severity. Reason 1, the yield. The average American savings account earns under 1%. Inflation has been running between 3 and 7% for the last few years. Every year your cash sits in a bank, you're losing real purchasing power. 5 years in a bank and $100,000 buys what $80,000 bought when you deposited it. The bank didn't steal it, math did. Reason 2, the insurance ceiling. FDIC covers up to $250,000 per account per institution. If you have $1 million in cash, 3/4 of it is technically uninsured. In 2023, Silicon Valley Bank collapsed. Customers with 7- and 8-figure deposits watched the entire system freeze for 48 hours, wondering if they'd be made whole. Reason 3, tax. Whatever pathetic interest the bank does pay you, fully taxed as ordinary income. So if you're in a 37% bracket, that 1% yield is actually 63 basis points after tax. You're going backwards faster than the inflation number alone suggests. That's the bank. Wealthy people figured this out a long time ago. Where do they put the everyday cash that needs to stay liquid? Treasury bills, direct obligations of the United States government. Right now, 3-month T-bills yield around 5%. Risk profile, 0. There is no scenario short of complete U.S. government collapse where these don't pay back exactly what they promise. They're the safest financial instrument on earth, and they're currently paying 10 times what your savings account pays. You can buy them yourself at treasurydirect.gov in 5 minutes. Or you can use a money market fund at any major brokerage. Fidelity, Vanguard, Schwab, that holds T-bills and rolls them automatically. Same yield, same safety, fully liquid. Here's the secret most people don't know. T-bill interest is exempt from state and local income tax. If you live in California or New York, you're saving another 10% versus a savings account's fully taxed interest. After tax, that 5% Treasury yield is closer to 5%. After tax, your bank's 1% is closer to 0.5%. This is where the wealthy keep their boring money. The cash they need access to. The emergency fund. The dry powder for opportunities. T-bills. Now stay with me, because this next one is the move that breaks people's brains. High cash value whole life insurance, structured correctly, becomes a private bank. Here's how it works. You overfund a permanent life insurance policy. The cash value compounds tax-free inside the policy every single year for the rest of your life. 3 to 6% guaranteed minimum, often more after dividends. Better than a bank, better than most bonds. But here's where it gets interesting. You don't withdraw the cash to use it. You borrow against it. At 1 or 2% interest from the insurance company itself. The loan is not taxable. There is no schedule to pay it back. And, this is the kicker, the policy keeps earning dividends on the full cash value while you've borrowed against it. Your money is in 2 places at once. The Rockefellers built their family bank on this exact structure 100 years ago. So did Walt Disney. So does basically every modern family office with over 50 million in assets. They call it infinite banking. Some call it the velocity of money. The mechanics are the same. Your savings stay invested, you live off tax-free loans, and the death benefit eventually pays everything off and transfers wealth to your heirs without probate. Quick check. If you're still watching, you're already thinking about cash differently than 99% of high earners. Hit subscribe so I can drop you the next one. Now, the asset class almost nobody knows exists. Private placement life insurance, PPLI. PPLI is a life insurance wrapper around a hedge fund. Let me say that again. You take a hedge fund, a private equity fund, a real estate fund, any sophisticated investment that normally generates massive amounts of taxable income, and you wrap it inside a life insurance policy. Now, all of the gains, all of the distributions, all of the income that fund generates accumulate inside the policy, tax-free, for the rest of your life. When you want money out, you borrow against the policy, exactly like infinite banking. When you die, the death benefit passes to your heirs, completely income tax-free. The catch, and there's always a catch, is that PPLI is for accredited investors only, with a typical minimum of about $5 million. You also have to follow strict diversification rules and can't actively manage the portfolio yourself. But for the people who qualify, this is the most powerful tax shelter that legally exists in the United States. The IRS knows, Congress knows. It has survived 7 decades of tax reform because the rules require enough complexity that only the very wealthy use it. It's not hidden, it's just invisible to anyone without a private banker. Last category, the cash equivalents that don't look like cash. Gold, specifically allocated physical gold stored in a private vault, not a paper claim. The wealthy hold gold not because they expect it to triple, but because it's been money for 5,000 years and zero counterparty risk. If every bank in the world failed tomorrow, gold would still be gold. Bitcoin for some. Same logic in digital form, held in self-custody, not on an exchange. And one more, the brokerage cash sweep. When you keep cash inside a major brokerage like Fidelity, your balance is automatically swept across multiple FDIC-insured partner banks. You can get coverage on millions of dollars in a single account while earning T-bill yields. Same liquidity, no single bank concentration risk. These are not the bank. None of them are. That's the entire point. T-bills, whole life, PPLI, gold, brokerage sweeps, 5 places the wealthy actually keep cash. Almost none of it sits in a checking account. Most six-figure earners reverse engineer the problem the wrong way. They earn more. The wealthy don't earn more. They store smarter. If you want me to break down the Gulf State wealth playbook, the centuries-old principles family offices in Dubai, Riyadh, and Abu Dhabi still use today, completely different from anything in the West. Comment Majlis below. This isn't financial advice. Talk to a licensed advisor before using any of this.
Thank you for watching. If you like this video, you should definitely check out this one right here, where we discuss the creation of a family office for those not rich enough to need one yet. It's time to stop reacting and start building your legacy.